not only can you can pay more for Medicare just because of your high taxable income, but it's kind of confusing on how they do that calculation to figure out how much you pay this year. Can you explain that to me?
Yeah, let me tell you about Ugly Aunt Irma.
Oh, okay.
Okay, so the IRMAA it's IRMAA, the income-related monthly adjustment amount for your Medicare Part B and your Part D premiums. So let's use an example, the one that you just pointed to a moment ago, where you might see the cost of your Medicare jump up on a month-to-month basis, but you could be stuck with an IRMAA penalty for as long as a year or two. So the Office of Social Security and Medicare comes out every year with a table that you can look up and see where you land, and it will tell you how much you're going to pay for your Medicare premiums. So for 2025, if your modified adjusted gross income is $212,000 or less, this is for a married couple, you're going to pay the base rate for your Medicare Part B and your Part D premiums.
So the 185.
That's good news. Right.
Okay.
So going back to this MAGI figure, what does that really mean? It's a pretty easy way to calculate it. If you look at your last year's tax return and find your adjusted gross income, it'll be on your Form 1040, and usually it just says it with bold letters. Yeah. And then on that same 1040, there's going to be a line that says, non-taxable income. It's going to be income from like a municipal bond where that interest isn't getting taxed. Well, you got to add that non-taxable interest back to your adjusted gross income, and then you get MAGI.
Whoa, wait. So you're saying the non-taxable interest on my municipal bonds caused me to pay more for Medicare?
Yeah. That kind of sounds like a tax.
It does kind of sound like a tax. And actually, unfortunately, the same thing counts for Social Security. Your tax-free interest on municipal bonds factors in to the taxation of Social Security.
Ooh, not so tax-free anymore.
So even though you didn't pay tax on the interest, it can cause you to pay tax on your monthly benefit.
Yikes. Okay.
Not great.
So taking a look back at this table, if you found it online, if you're a married couple on Medicare, and let's say your MAGI is above $212,000, well, you're going to be paying more. That's the first area, the first bracket, or sometimes it's called a cliff. If you fall over into the next IRMAA cliff, that will trigger more cost for your Part B and Part D premiums. And it can add up to $100 a month or way, way, way more in some cases.
Yeah, I think the top one's over $600 a month for just Part B.
Oh, yeah.
That's ridiculous.
Now, you've got to have quite a bit of income to get there. And believe me, there are some circumstances where you can come across some income like that. Maybe an inheritance wasn't handled correctly, and now you're paying more for your Medicare for at least a year. You're just kind of stuck with it. So Social Security and Medicare, they look at this IRMAA number from 2 years ago. So 2025, what determines whether you'll have a penalty is what your MAGI was 2 years ago.
In 2023.
In 2023, that's exactly right.
That's not confusing.
So here is a really, really sneaky, ugly situation that can come back and bite you in the butt later.
Okay.
Jeremy, let's say you are 75 years old.
Perfect.
And 2 years ago, you had a required minimum distribution.
Yeah.
So the IRS came to you and said, hey, Jeremy, you've got a tax-deferred account, and you've been deferring those taxes for probably 40 years.
Yeah.
Well, the day has finally come where it's time for you to shave off some of your IRA, pay the taxes on it, and give it to us. Now, sometimes that shave can be a lot bigger than we want it to. Okay, so that was 2 years ago. You dealt with that pain. You've totally forgotten about it. It's now 2025, and now you're getting hit with another bill from Medicare saying you've got to pay more for your Medicare premiums because you followed the rules 2 years ago.
Amazing. I love the U.S. government. This is awesome. This is great. This makes total sense.
But the good news is that it doesn't have to be like this.
Okay.
So, Jeremy, tell me about a tax strategy where you can keep the IRS happy, pay the least amount for your Medicare, and actually get to the 0% tax bracket.
Yeah, I think what Matt's probably referring to is there's a handful of strategies that can accomplish this, but one that we utilize a lot in our practice is something called a strategic Roth integration,
You betcha.
or a Roth conversion, as sometimes it is called, which essentially says, hey, let's take this IRA tax-deferred money, voluntarily pay the taxes now while taxes are historically low, get it out of our system, cleanse it of taxes, get it into our tax-free, bucket, anything that is considered Roth, a Roth IRA, Roth 401k, Roth 403b. And once it is in that bucket, the amount you put in there and the growth on that is tax-free. So not only do you get to experience now growth and gains and compound interest in a tax-free way, but everything that's in a Roth type of account isn't subject to those required minimum distributions.
Because the money's already been taxed.
Exactly. The whole reason a required minimum distribution even happens is because, you've essentially said, hey, government, I'm deferring this money and I'll pay you later.
You're just kicking the can down the road.
I'll pay you when I take it out. And guess what? The government eventually gets sick of waiting. And so depending on your birth date, if you were born before 1960, that would be the age of 73 when you have to start pulling those funds out every single year. If you're born after 1960, it's age 75. But if you have it in a Roth IRA, you've already paid the taxes. So the government, they don't care. They're already happy. They already got their tax dollars. So if you don't need to take the money out of the account, you don't have to. So that allows you to keep the money in there that you want to keep in there. It grows tax-free. If you need it for some reason, for your living expenses or anything like that, well, guess what? When you pull it out, it doesn't even show up on your tax return because it is tax-free. It doesn't cause your Social Security to be taxable. It's not
invisible money.
Yeah, it's not factored into provisional income. And it doesn't cause your Medicare to have a IRMAA penalty or anything like that on it. So then we have many clients who they might have 6 figures of income every single year in retirement, but they're in the 0% tax bracket.
It feels like magic, doesn't it?
It's awesome. It's really, really great. But just like anything else, it's like going to the doctor. It's like, hey, I got this shot for you. It's going to help protect you from the really bad stuff, but I'm going to jab you with this needle. It's going to hurt a little bit up front.
Can we talk about needles for a second? I am the worst when it comes to needles. I
Really?
don't like them. I've got to get my labs done at least once a year, and I put it off as much as I can. I
Okay.
hate needles.
Well, sorry, but I guess it works for you because I guess envision that. But essentially, it's the same way where, sometimes people, they go, I got to pay those taxes now. I don't like seeing that tax bill. But, it beats paying the taxes later when tax rates might be higher. At least in my opinion, I don't see tax rates going lower anytime soon.
I don't see it happening.
Especially with the national debt. It's not a Republican problem. It's not a Democrat problem. It's a math problem. And we've got to pay for it some way. And every other time our country has had a huge debt like this from a war or anything like that, a pandemic,
Yeah, and speaking of the big national debt and paying for it some way, even Nancy Pelosi has said in years past, don't worry about the national debt. It's fine. We've got trillions of dollars in tax-deferred retirement accounts that we can just mandatorily pull out. They have to pay the taxes on it. Boom, debt gone.
Yeah, we don't have to worry about the debt and what we're spending because we still have all those IRAs that we haven't taxed. So the people
even Washington knows where today's retired Americans are vulnerable.
Their eyes are on your retirement account, which is terrible. And so it makes sense. Let's get it out of our system now before they have the opportunity to raise those taxes. And then you have the control over it now so that, especially also, if you wait 10 years to do that, we all have our money invested in some sort of way. The goal is for that to grow, right?
Right.
Okay. So if we could convert the money now when it's worth $500,000 and pay the taxes now on $500,000, that'd be a lot better than waiting 10 years and maybe it's grown to, $1 million and now we have to pay taxes on the $1 million to convert.
Well, and the way that you get to paying taxes on $1 million, it's not going to be in one big chunk,
yeah.
some year when you're 80. It's a very, very slow and sneaky process. So these required minimum distributions on your 401ks and IRAs, that shave off of your account that I was referring to, well, every year they're going to shave out a little bit more, a larger portion of your balance to pay taxes on. So if you've got an IRA that's growing in today's stock market environment, it's done great for the last 18 months.
Yeah.
And you're shaving off some taxes on a growing balance, and the shave is getting bigger. You just signed up for a lot of taxes in just a handful of years.
Well, yeah, what a lot of people don't know is, back when they were told, hey, put all your money in your 401k for your company, and you just put the 5% away and get your match, which is a great idea. Obviously, we want to get the free money. But the problem is you didn't know this probably, but you were making a bet. You were making a bet with the government that when you need that money and when you take it out, that the tax rates will be lower.
Whether you knew it or not.
Whether you knew it or not. And at some point, whether you need the money or not, they're going to force you to take the funds out, get the taxes, whatever that rate is, and that could then blow up your Social Security, it can blow up your Medicare. It's all intermingled, which is why we focus so heavily on holistic retirement planning. Because, just simply going through and answering the question of when should I claim Social Security, it's not that simple.
Yeah. And speaking of holistic planning, one of the questions that I hear your clients ask you quite often is when to take your Social Security. And you've mentioned in class over and over again, the way you answer that question is not the way you answer when you should take Social Security is whether you have a tax problem or not. Is it better to access my retirement savings and investments for a handful of years and wait to claim Social Security later when the check is bigger? Or should I claim earlier and rely a little bit more on my investments later on?
Exactly, because at the end of the day, when you choose to finally claim your benefit, there's a lot of factors that come into play there. And so one of the main that he's mentioning is that the tax problem. If essentially when you decide to claim, you have two paths that you're going to go down. And you can either, one, say, well, I'm going to start taking my Social Security check now so I don't have to deplete my assets so quickly, my IRAs, my 401ks. Or I can deplete my IRAs and 401ks now a little bit more so I can let my Social Security grow faster.
Right.
So that then whenever I do claim it, maybe I don't then have to touch my investments at all at that point because the benefit's larger. And so there's so many calculations and factors that go into play to figuring out the optimal time to claim Social Security. And when we look at that, taxes are a huge play in that. And, the earliest you can claim is age 62. But that's also what's known as your minimum monthly benefit. Because when you claim at age 62, well, you're getting a 30% reduction. And it's permanent. It goes with you for the rest of your life. And potentially the rest of your spouse's life. If, us guys, we're going to pass away first, statistically. And so we got to make sure that when we claim, that it also is good for the ones that we care about the most. That it's good for us, but it's also good for our wives.
Right.
And so, because they get to keep the higher of the two checks. And so if I lock myself into that 30% reduction, then that's going to carry on to them, basically. And versus most people's full retirement age is age 67. There's some birthday things, but for right now, we're just going to say it's 67. And what that means is that is essentially when Social Security pays you 100% of what you're entitled to get. You've paid money in year after year, and that is 100% of the benefit that you're supposed to receive. Then, if you wait, you can delay up to age 70. And age 70 is your maximum monthly benefit. So you get a larger benefit, and each year you delay, you get essentially an 8% increase.
That's pretty good.
That is pretty good, but here's the thing. Every year you delay, that's just another year that you didn't have income coming in. That's another year you had to start spending down your IRA or 401k. And so when people ask me that question, when should I claim Social Security? There is no one right answer. Everyone's situation is completely different. It depends on how much income you need in retirement, what your tax situation looks like, where your investments are and how they're being managed. And, a lot of factors also with you and your spouse, or if you're single, do you have a minor child at home that you're taking care of? There's so many different factors that go into that. And so when you look at it holistically, it allows you to not only make sure you're claiming it right for yourself, but for your spouse, and that it works in your whole plan, factoring in inflation, taxes, cost of living adjustments, everything.
So given all of the combinations that you and your spouse can claim Social Security benefits, first of all, how many combinations are there, and how common is it for people to get this right?
Oh, there are hundreds and hundreds of combinations of claiming strategies between spouses, and actually the amount of people that get it right, the amount of people that claim their benefit at the optimal time is 4% of people.
Oh my gosh.
Yeah. So that's about 1 in 25.
That's terrifying.
That's not good. That's quite low. And what that means is the other 96% of us, we're leaving money on the table.
Yeah. A lot of money as a country.
Yeah. We're either not getting the maximum benefit, or we're paying unnecessary taxes because things aren't structured right. And so, because again, it's not about what you make that matters. It's about what you keep.
Yeah.
Yeah. And so by structuring it properly, you want to have the largest benefit possible, and ideally no taxes on it whatsoever.
Mm-hmm.
Yeah. And so when it comes to Medicare, I know it's a lot more complex than Part A and Part B, because like you mentioned, there's this 20% copay that I'm going to have to figure out where that comes from. And there's a lot of things that Medicare doesn't pay for. So how do people even start looking into options and ways to get coverage for those other things that the base Medicare doesn't even pay for?
It's a good question. You're signing up for Medicare, but you're not sending that paperwork to Medicare. You're sending it to Social Security.
Got it.
Make that make sense.
I can't.
Wait times on the phone or even for Social Security offices is just crazy.